Well, the most important thing when you're looking at all these numbers is the income statement. This tells you where your income comes from. Now, I've seen income statement. The income says, $1 million came in, but a facility does massage and rehab and sells weight loss products and sells nutritional products and maybe even has a laser. Well, where is that income being derived from? It's important to see that. I've seen somebody who I've asked them, what percentage of this income is derived from the products or nutritional products that you're selling. And I've seen people off by 300% in their estimate. Because we're not great at calculating the day-to-day, our brains aren't computers, obviously, we have to rely on statistical data. And the reality is if we can't measure it, we're not going to be able to improve it. So if you look at a Subway or a Walmart or a typical franchise, you're going to see very little standard deviation. That means how much their profit margin is deviating from one store to the next. Yet in chiropractic offices, one office is 5% profit margin, the other office has a 75% profit margin. Huge deviation, and the reason is the person with the 5% profit margin doesn't know how to extrapolate, how to interpret the data and how to read this data and then respond to the data. So we want to categorize the income from patients, how much is derived from products, how much from other services or from investments that the practice has made. We also want to categorize the expense side of things. So as you look at, for example, on wages, we see that 25% of the national average chiropractic firm is attributable to wages. 1/4 of the gross that they collect is wages. Very labor-intensive business, obviously, because it's a service business. However, we want to delineate, we want to separate the owner wages from the employee wages so that you can see how much money went into your pocket. And now you're able to more clearly discern what your profit margin really is, because what you pay yourself as a salary may be completely arbitrary. We've seen people pay themselves a salary of $20,000 a year. We've seen some pay themselves a salary of $200,000 a year. There's a big discrepancy there in how much one is paying in payroll taxes versus the next. That's taxes is a separate webinar, and there's videos on the website for what you might want to pay yourself in guidelines. So we won't get into that today, but you want to separate those two. So be as detailed as possible. Have your bookkeeper be as detailed as possible. Heck, have your bookkeeper watch this webinar. So as we look at income ratios, one of the things that I like to look at, I put at the top of the list here, what are your net income increases? Not gross, but your net income increase to the pay increases. If I gave everyone in my office a 6% raise this year, or average of 6%, some people got a 4%, some people got an 8%, and my income went up by 20%, well, that ratio is going to look extremely attractive. So I want to measure what that is, and similarly near the bottom, I want to measure what is my operating income to wages and salaries, or net income per employee. If I add one employee, is that going to add $120,000 in revenue? How much should it add? It's important that we know these numbers, because one of the things we don't want to do is increase revenue by 20%, increase costs by 30%, and we look at the top line gross number and say, wow, my collections went up by $10,000 a month, but then we take a look and realize that the profit margin was 50%, and now even though you're collecting more money, your profit margin is 30%, and so you're actually making less in your pocket. You see, it's always going to come down to how much money you're putting in your pocket, not the gross amount that you're collecting. I know plenty of people that collect $100,000 a month and are completely broke, and I know plenty of people that collect $30,000 a month that have their house paid for and they're doing extremely well. So it's not about the gross. You'll notice these numbers are net income per employee, net income to assets, non-operating income to net income. These ratios are about how much you're netting, and they're about your profit margin.